Welcome to this walkthrough of the EPC Builder Model Template. This is a financial model spreadsheet template designed by us to assist EPC companies to forecast the execution of their EPC contracts. EPC stands for Engineering, Procurement and Construction. Ergo, these are companies which not only manufacture certain goods, but they also take responsibility to tailor the production to the installation on site, and they take full responsibility up to the installation of those goods. Typical examples include builders for pipelines, wind turbines, solar parks, storage tanks, tents, or even cable cars, or any other good which can be produced in mass and installed on site under EPC contracts. The purpose of this template is to simulate the execution of one or multiple large EPC contracts, in this case delivering pipes, and based on a set of assumptions including their timing, their costs and profits, we want to know how such a business will perform financially and how the forecast over the next months and years will look like. And based on this forecast that we can run financial analysis, and we can also obtain a view on the usual feasibility metrics in order to assess how profitable such a business venture might be. And in case we are teaming up with joint venture partners, we would also like to obtain a better idea how profitable such a business proposition might be for them. In the following, I'm going to show you how to best work with this template. A link to the template referred to in this video is provided in the description below. Before we start, don't forget to hit the subscribe button to our channel. So let me walk you through this template to explain you how it works. The structure of this template consists of several worksheets. We have here a sheet with the summary, forecast and financials and metrics, a sheet for assumptions, contract assumptions, but also overhead assumptions. Then we also have a separate sheet for the cost assumptions per contract, and then worksheets to come up with forecasted monthly and yearly financials throughout the whole projection period, and also a sheet to look into the profit sharing between joint venture partners. The spreadsheet is color coded. Assumptions are marked in blue. These should be cells to be manipulated. Cells marked in black are calculations or output. They should not be manipulated. And we also have a series of navigation links in this template. So if you need to jump to a certain topic, you can simply click the navigation link, and on the top left there's always a link back to the navigation menu. This makes it much easier to find your way around into the model, and we suggest that you go through the topics listed here. The way to start with this template is here on the assumption sheet. We need to define what we're going to build. As said, this template can be used for different purposes. In case we would, for instance, build wind turbines, we would change it here to wind, and it takes here the presets from below. So if we want to change some of the units here, we would do that on these lines here. We shortly need to check that now the contract size makes sense. So let's say now we measure the size of the contracts in megawatt peak of installed wind capacity. And this also means we need shortly to update the setting here. For instance, if we install 50 megawatt wind turbines, we would need to manufacture 67 wind turbines during the course of this contract. For the purpose of this video, I'm changing it back to a pipeline manufacturer, and this one is basically the question: how many pipes per mile or per kilometer can be built. In this case, I changed the setting back here. Then the way to start is to go through all the assumptions in blue and see what we need to change. And most importantly, we need to work here on the contract, on the assumptions regarding to the EPC contracts we plan to obtain. There are up to 10 contracts offered here to enter. Here we can either include or exclude them into our forecast. What I would recommend to start with this template, I would first focus on the first contract and start calibrating this contract correctly. In this example, these figures are pure examples only. We define, for instance, that we need to build 1,000 miles of pipelines. We need certain number of pipelines per mile, and ergo we need to manufacture a certain number of pipes during the contract term. Then we need to define the start date and the duration of these contracts, and we can check here if these delivery dates make sense, and if not, we need to adjust them. There is also a supply chain included for that, for delivering that. And this is up down here. So we have different phases for delivering our contract. These can be changed over here. We need to order components. We need to manufacture the product. We need to transport and to commission the product. The important to note here is that manufacturing is the one which in this model is assumed might be subject to capacity limitations. We come to that where we will have to plan if we have sufficient capacity to produce the required number of pipes in these examples. We'll come to that. In this example then, we start here with the calibration of the contracts. We then jump to the cost assumptions. So for each contract, we need to go through and basically list what are the cost items, what will be our cost to deliver this contract, which stage we need those items, or they will have to be purchased. We can plan either per item or also on another weight or time unit basis. And the cost, they can either be on the whole contract, for the whole contract, or on a per pipe basis. And then we enter, so if the cost per contract is 50,000, so we have here different sourcing scenarios. And as you can see in the assumption sheet, we can also simulate that each contract can use a different cost structure. Either their sourcing is local, outsourced, or JV. And this, in this case, is reflected. So this could have different price or cost options. And we want to basically calibrate that. So what we do is we enter the assumptions here. It gives us the costs, in this case per pipe or per contract. And then when we apply the size of the contract, we then can figure out what's the total value of the contract. And we do this, we work through all of these items until we obtain the total costs. And then we need to add a cost markup. That's normally how these costs are priced. So if you have a cost budget, we add a certain profit margin, and then this will give us the value to be charged to the customer. And then if we think we are too high or too low, what we can do is we can use a different sourcing cost structure. So we can switch and we can see how this changes, and we can also see if in this case what will be the implied cost per pipe if we change here, if we source our items from different options. And also what happens if we change the profit margin up or down. Once we have the contract value and we are done with our cost assumptions here, we can then also look into the payment plan. So there are different ways how we can request payment from the client. We can request payment when the contract starts. That would be the down payment. So we can say how much of the contract value should be in form of a down payment, how much then for the completion of certain milestones. Then there is also an element if you want to charge, basically if you have here if you plan to that this will take 3 months. If you want to charge a certain amount on a monthly basis, that would be to enter the portion here, and then you can see the value of that, of the total, and then divided by the number of months will give you the monthly invoice to be sent to the client. Then other option are is to move some of the payment to the completion, so once the full contract is completed, or if you are in delay, in that case we run the simulation here and we work a bit with the manufacturing capacity, and if we would see that we don't have enough capacity and we're limited, then some orders are not executed, the dates shift, the scheduled end date shifts, and if this is beyond the target date, we could also define in case we would have to pay a penalty for late payment, and then so that we would be at a disadvantage if that would happen. This one is not in our cost budget because we should not plan for penalties, but it would then show up here in our forecast, which then basically reduces the revenues. Where is that? Here there would be there's a penalty line which then would show up. Other factors of relevance to EPC are basically price escalations. If there's a lot of inflation, we have here a cost inflation assumption. This is basically assumed to apply for all contracts. We can set this as we like. And then the question is, what happens if the cost increases? So let's say if the cost increase is less than 5%, we can either pass it on or we can change it to 0 so that we cannot pass it on, or we can basically have two different sets below a certain threshold or above how much we are allowed to increase prices. So this allows us, in short, to configure the revenues and the cost for delivering these EPC contracts. We can do this for up to 10 contracts. We can change the start dates, the delivery times, exclude contracts. That's the whole idea of this template. Then what we also need to think about is manufacturing capacity. So in this case, we have one contract to deliver. These are 220,000 pipes we have to manufacture, transport, and install, as you can see here, during the course of 3 years. And now we need to know if we are running at full capacity or not. So you can see here, if we have a capacity of 7,000 pipes per month, maybe the available capacity actually is lower. It either is 100% or it's less, depending how you define it. And this means we can manufacture up to 75,600 pipes per year. This is basically just close to what we need. And if we need to add a bit more spare capacity, this model foresees that we could add this. So, and then here this is a bit too late, so we need to add the capacity earlier on. And you see the capacity utilization then basically goes down. If we add here capacity increases, important is also to configure the capex. And we have here an assumption here. You can then also define what will be the effect of adding more production capacity. How much do you need to invest, among other assumptions, which basically build our capex budget, which is needed to set up the whole operation. So we can play around with this. We can also include other contracts. Then if, for instance, we have contracts entering later on, you see then the demand goes up, and maybe if we would basically not do anything, it could be that we are running here at full capacity, and we have a huge order backlog building up. So that means in that year we would have to invest into building up additional production capacity. And this is what the model allows you to do, to figure that out. What's the plan for going forward, how to manage this, and what are the cost, capex, revenue, and profit consequences. For our purposes, I will disable these contracts again to keep it easy, and also no capex needed. Then based on our assumptions so far, I've configured the revenue per contract and the cost per contract, but it can also be that this company has overhead. They might need to hire people on a permanent basis, which cannot be allocated to each and every single EPC contract. So there is a section in the model which allows exactly to do that. So you can here simulate the costs for hiring a different number of staff at different cost levels, and also operate a budget for operating costs. This then goes into basically a monthly forecast, and on this big monthly sheet is basically a forecast with all the calculation, which then result in a monthly profit and loss statement. So we can exactly see when we are going to receive which revenues, and we actually do this month by month for all the years. This is year 2, 3. We can look into all these years and follow and trace back the numbers where they come from. That's the beauty of Microsoft Excel. And we do that here for the income statement, but also for balance sheet cash flow statement, because what we want to figure out is how is our cash balance developing? Do we have sufficient cash on our balance sheet to deliver this? And then by doing all this calculation, this allows us then to build a yearly forecast. As you can see here, this is just including one EPC contract. It will end by year 3. So either in year 3 we'll either have to dissolve the company, or we will have to find new EPC contracts depending on what this business is supposed to do. The last part we need to define is basically the assumptions for the financing. So we have here calculation how much funding is required, and depending on the funding required, we can then also figure out should this be financed through debt or equity. And if we want to use debt financing, we have here a section to simulate that we use up to 2 facilities of financial debt. We can say how much, when this debt facility will be used, and in which month of the forecast the repayment then will start, and also the repayment terms. This allows us then to use some leverage for our forecast. In this case, not much, but it's just an example. If we want to go back, we can also have a look at the summary of our forecast. Either here's a switch, we can also look in larger figures how this will look like, and we can then check if this makes sense. In this case, you see we have here some profit, but it varies a bit, and also we have a lot of overhead because of the assumptions. So in that case, actually the model was calibrated for more contracts. So let's say I finalize this and we include all these contracts. Then the plan looks a bit different, and now we are profitable in some years, but we are still subject to some volatility. This is due to assumption. I would have to recalibrate them. And then basically the model outputs all you need to know about the plan of executing these 10 EPC contracts. It also gives you an IRR. In this case, it's not very profitable, I have to say. So let me just change a few things. It's not profitable because we have not enough manufacturing capacity. We can actually not even deliver. So you see here, we are way behind our schedule. We go here to capacity planning. And as you can see here, we're running all at full capacity, and we have here a huge order backlog building up. So the problem of this forecast is that we don't have sufficient manufacturing capacity. There's something we can easily solve. We just add manufacturing capacity. Voila, and also here, so it's all added. This will lead to capex consequences here, because we need to build up to basically manufacture all these required pipes. Now if we look back, we can make profits with this plan. And now also if we look at IRR, now actually it's pretty profitable. The spreadsheet then also allows you to analyze the contracts in more detail, to compare contract by contract, or let's switch that back to millions. Look at the composition of the revenues, what type of revenues we expect. So if we would not have enough manufacturing capacity, let's say here you see there are order backlog, means we cannot deliver in time. Let's make this a bit bigger, and you see the consequence of that is that suddenly we have to pay penalties in this model. If we want to get rid of the penalties, we would either get rid of the penalty clause. That means we have no penalty to pay, and then it disappears. The cost disappears, or if we have to pay, it stays, but then in that case we'll have to make sure we added enough manufacturing capacity to deliver all these pipes. This model then goes on, allows you to analyze contracts in more detail. You can switch from one contract to the other to basically analyze your forecast to make sure that each contract should be profitable. Analyze in more detail the available capacity for manufacturing, in this case the pipes, composition of revenues, etc. And you can then also obtain more detailed insights into the monthly plan by looking at when the money should come in. We can look at year one or any other year you like to look at. The model then outputs the figures and then allows you to obtain a better view on how your business is supposed to develop. Another topic to mention is sometimes certain manufacturers obtain production tax credits. There's also a model included for that. This depends on your sourcing option. So depending on sourcing option, we need to define if there is a production tax credit available, at which stage it occurs. In this case, we could be defined on a per pipe basis what credit would be available, or for wind turbines on a per turbine basis. This is just illustrative example to illustrate the point and the mechanics how this works. And in that case, the tax burden is then, these credits are then used to reduce the tax burden. And lastly, we can also look into joint venture assumptions. So let's have a look here. We need the assumptions for joint ventures. We have here different owners of this business, up to 5 owners, the investment and the equity share. And if you would split the profits, then we have here calculations on that sheet, which then basically forecast how much each partner has to invest and when the cash proceeds will arrive. And then this also leads to the expected profitability for each joint venture partner. So overall, I hope this walkthrough gave you a good idea what this model is all about, what it can do, and hopefully it can serve you to plan delivery of an EPC contract. And I hope this is useful. If you like this video, please give it a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.